Hello, everyone, and welcome back to another live stream. We have the official FOMC press conference by Jerome Powell coming up very shortly in just over 15 minutes' time. The Fed decided to hold the interest rate at the same level that it was at, so no change to the interest rate. That was expected. There was around a 99% chance that they would maintain the current Fed's fund rate as stated by Polymarket. Anyone who was on Polymarket knew there was a 99% chance of no cut, and not a surprise to me at all. But the important thing, as usual, is what Jerome Powell actually says regarding the economy during his press conference. People are talking about, will there even be a rate cut in 2026? We're going to have to hear it from the horse's mouth. We're going to have to listen to Jerome Powell and see what he has to say about the prospects of rate cuts going forward this year. Most people assume there's not going to be a rate cut in the first half of the year, but there may be a rate cut or two in the second half of the year. It's going to be very, very interesting to hear what Jerome Powell has to say about that. I was listening to Bloomberg earlier, just listening to some of the analysts on there. And one guy was actually saying that he thinks the next decision from the Fed could be a rate hike because of the inflationary pressures that things like the Big Beautiful Bill and the increased growth are going to cause. So that could be a huge shock to the market if that ever happens. I'm not personally foreseeing that anytime soon, but time will tell. I mean, what I'm seeing right now, inflation's coming down. I know the Fed don't go off trueflation, but if you go ahead and look at trueflation, inflation's absolutely capitulating. It's coming down massively. So I'm not too worried about inflation coming back anytime soon. But obviously, it's not about what I think. It's about what Jerome Powell says during the press conference, which is in about 15 minutes' time. Bitcoin coming down slightly after finding a high of the day around $90,500. The S&P 500 just surpassed 7,000 for the first ever time, making a brand new all-time high. But we're seeing a little bit of a pullback here just in the last kind of hour or two after Bitcoin came up to 90,500, as I just stated. We had a very nice breakout to the upside. We then came back down. We retested this support multiple times. You can see multiple hits of this support level as a retest followed by a bounce. So what I'm watching for in today's press conference is whether Bitcoin loses this support level. If it does, that will not be very good for the prospects of a bounce here, because you can see how many times it's actually been respecting this level during the trading session for the day. So Bitcoin was in this bit of a compression structure here. We finally got a breakout. We had a nice move to the upside up to 90.5K. Now we've come back down. Bitcoin currently trading around 89,400. There's still a lot of liquidity to the upside. If you go and check something like the Bitcoin liquidation heat map from CoinGlass, and you go ahead and you look at the 2-week chart on that, you can see that there is a ton of liquidity building up to the upside there. As we came down and took most of the downside liquidity on that dump during Sunday. You can see on my screen here all of the liquidity to the upside. We have got a little chunk of liquidity here at 86,900. So just be a little bit aware of that. But besides that bit of liquidity, there is a ton building up to the upside, all the way up to 98K. So I do believe Bitcoin is going to make that move. We've been monitoring very closely this structure that Bitcoin's been in on the daily. We've got the lows of the range, we've got the highs of the range, and I said to you guys that as long as we hold the lows here, I would not be surprised if we start pumping back to the highs of the range. And so far, we've had 3 consecutive days in the green, so we absolutely nailed that prediction on the channel. As I said, you've got to just maintain the belief that we're going to stay in the structure until proven otherwise. Sometimes these structures, these ranges can go on for a lot longer than you may think. Sometimes they can go on for 3 months, 4 months. Even in 2024, we had a sideways structure for 8 months or 7 months time. So These kind of structures can definitely go on longer than what you think. They don't always have to lead to a breakdown instantly, though I do believe eventually we will make a move to the downside just because this structure here to me is a bear flag. It is indeed a bearish structure. You have your flagpole here coming down from the all-time high, and then this is your actual flag here. Eventually, I believe we will lose this and we will make a move down to the 200-week moving average. But in the meantime, we can very much chop in this range for many, many weeks to come. And I do believe there's a strong chance that Bitcoin will make another move up to the highs of this range around 100K. That will line up with the 50-week moving average and a major psychological level of $100,000. So I do believe that is on the cards. If this FOMC goes well and Powell isn't too hawkish, then I actually believe that that could kickstart the run up to these levels. And then we will have a brutal rejection at some point that will inevitably lead to a move down to the 200-week moving average on Bitcoin, which always seems to get hit during a midterm year. This time to me seems to be no different. Anyway, get your comments in the chat. We have over 100 people watching live. Hit the likes up on the stream. 13 likes only on the stream, yet we have over 100 watching live. Please do hit up the likes. I'm going to be bringing you Jerome Powell's speech in about 10 minutes' time. Let me know what you guys think about the press conference. I'm going to put a poll in the chat. Will the speech pump or dump BTC? That is the question for you guys today. Will the speech pump or dump Bitcoin? What are you thinking? Will it lead to a move to the upside, or will it lead to a move to the downside? What I'm actually liking here is Bitcoin showing a little bit of caution going into the press conference. Usually when we're skyrocketing into a press conference, that is a signal to me that we're probably going to have a pullback during the press conference. But I like the fact that we're seeing a little bit of a cool off of this rally as we go into the conference. That allows the RSIs to reset. If you take a look at the RSI on the 15-minute, it is resetting right now, the stochastic RSI. So I'm liking what I'm seeing in that regard. When you're seeing these major green candles going into the speech, it's already priced in to be bullish. So the slightest negative thing can dump the price. Now, I want to just quickly talk about the situation with rate cuts for this year, because many people believe there will be no rate cuts. Many people believe there will just be one rate cut this year. But what I want to talk about is how Powell is going to answer the questions regarding the prospects for rate cuts this year. As of right now, the market is predicting there will be no rate cut in March and no rate cut in April. So that's already the expectation. So if Powell comes out and even hints at the slight possibility of a rate cut in the first half of the year, he just hints at it, or he doesn't discard it. He doesn't say no, it's not going to happen. He kind of just says that it might be a possibility. If Powell even hints at a rate cut in the first half of the year, and you've got to read between the lines because he's not going to say it clearly. You've got to be able to infer from what he says. But the point I'm making is if he hints at that, the market is going to take that in a very bullish manner, because as of right now, there are basically no prospects for a rate cut in the first half of the year. Every analyst is saying they're not going to do it. Every YouTuber is saying they're not going to do it. No one is expecting a rate cut in the first half of the year. So if they even hint at that, you're going to see the probabilities on Polymarket start to shift for the prospects of rate cuts in March and April. And if that happens, I believe we could see a bit of a move up with Bitcoin, because right now we're already going into it with bleak expectations. And if you go into an event with low expectations and the slightest thing that's positive comes out of it, you can really see a move to the upside. So that is what I'm potentially listening to. I'm also interested to hear if there's any talks about the new Fed chair, and also the QE and QT situation. Obviously, they ended QT, so that's not really something they're going to talk about. But QE is now arguably occurring. Depends what you call it. Some people call it QE. Some people don't call it QE. but essentially they're doing some form of quantitative easing, and it will be very interesting to hear what Powell has to say if there's any questions coming up regarding QE. So yeah, Bitcoin pretty flat right now heading into the speech. We have the speech in 7 minutes time. I'm going to go through your comments just before we get into the speech. Let me know in the chat, what are you guys expecting out of this press conference from Jerome Powell? But yeah, guys, look at Hyperliquid. Look how high Hyperliquid is going. I told you guys on the last not the last live stream, but the time before, I gave you Hyperliquid as the altcoin I would get into as a potential trade. I gave you guys that for free, completely free, and it's up 58% in the last week. So guys, just make sure you're watching these live streams, because there's going to be great snippets of information, great opportunities that I just subtly give you. Hyperliquid's the biggest gainer in the entire market. And that was the one altcoin which I shared to you as a potential trade opportunity. Remember when I brought it up and I showed you the downtrend that it was in? I know what I'm doing, guys. So yeah, Hyperliquid skyrocketing today. Gold is up 4% today. Gold is at 5,300 pretty much. Incredible what gold has done. But Bitcoin, relatively flat. We had a move up earlier on in the day. Then we had this big move down. We've come back up again, and we've come back down, kind of like an M pattern. Basically just reset the stochastic RSI here going into the FOMC. So I'm a fan of that. I would be a little bit cautious if we were going into it with quite a high 15-minute stochastic, but we're going into it with quite a low 15-minute stochastic. So I'm a little bit optimistic, guys. I really am. I mean, it can go either way, obviously. All it takes is Powell to say one really bad thing and the market can crash. But I'm kind of optimistic going into this press conference because the market's already expecting no cuts. If he just gives the slightest hint, then I honestly think it's going to do great. Anyway, let's get into the comments, see what you guys are saying. 157 people watching. The Fed is always 6 to 9 months ahead of the markets. Look at higher time frames. Says Todd. Okay. You didn't mention Hyperliquid in the alts you would buy in your last video. Stop bragging. Bro, what are you on about? What is this guy on about? It's literally in the thumbnail and included in my last live streams, bro. I've been talking about it for the past few days. I literally gave it as the altcoin I would be getting into. I gave you guys that for free. So what are you chatting? Absolute nonsense. I also included it in my 2026 crypto watch list. Don't know what you're talking about, my friend. How bad will silver drop if no rate change? They've already given the decision today, guys. They've already said there's going to be no rate change. The decision was already out 27 minutes ago. The Fed are pausing. Thank you, Bruno. I did talk about Hyperliquid before it pumped. Thank you. Yeah, anyone who watches the streams or the videos will know it's been one of the altcoins I've been harping on about for the past 5 days. It's one of the main alts I've been talking about. Probably the alt I've talked about the most in the last 5 days is Hyperliquid, and the chart that it was in a downtrend and it looked like it was going to break out. So I don't know what nonsense that guy's talking about in the chat. Yeah, Ricky says he's not bragging, and he did tell us about Hyperliquid. W Archie, appreciate that. Yeah, multiple times, exactly. There we go. People know. People have been watching the streams. Just one guy hasn't been listening, so it's not my fault that he missed it. Audio D says say or Ondo. Both of them are very oversold. So if Bitcoin gets to move up to the range highs here, as I kind of expect it to do, I think they're going to have a really nice bounce, but time's going to tell. Be very cautious though, guys. If you are in high leverage positions, we are going into an FOMC speech. So you can see huge volatility during these events. So you make sure you've got tight stop losses. Make sure you're not using high leverage. Omar says, smash the likes and get your questions in. Absolutely. Press conference is about to begin, guys. So I'm going to bring it to you live on the stream. Don't go anywhere. Let's get it up. Please just let me know in the chat if you can hear the audio.
Kingdom. Tom, the biggest risk to the GDP growth we've discussed over the last 12 One of those
Can you
issues
guys
we've
hear the
talked about
audio?
for the
Please
last
just
few
let me
months,
know.
the last month or so, has been the introduction of a cap on interest rates on credit cards. That could have the complete opposite intended effect of chilling financial conditions, of tightening credit availability. And they're the kind of things that at the moment, this administration, TK, they're the kind of things they're thinking about.
I think the phrase is grasping at straws. I don't hear much policy or science behind it. Maybe we'll hear that in these comments.
Torsten, this just in from Hugh Van Steenis of Oliver Wyman. I'm sure you know him. He wants us to start a podcast and wants to know if Mark Rowan will give up Torsten once a week so we can do a little podcast together. He liked the last hour so much.
First guest can be Hugh Van Steenis.
Do you think Mark and Jim will get on board with that? Can we have you once a week? Can you write
Yes or no? Can you hear?
In the surveillance
Yeah,
budget?
I can work it out.
Yes or no? Can you hear
Torsten,
it?
this was a pleasure. Thank you, sir.
Thank you.
Torsten Slock there of Apollo. This could be a snoozer over the next 60 minutes. The last 60 minutes has been anything but. Equities right now very close to all-time highs on the S&P 500. The S&P 500 negative by about 0.2%. For the chairman of the Federal Reserve, let's take a listen down in Washington, D.C.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today. But and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today, that either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the U.S. currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But, what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made. What we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rates, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range. But so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. So Is that, if you had a follow-up?
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira. Thank you, Chair Powell. Amira Mokwe from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but the committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to employment have probably both diminished a bit. So we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, ex the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. hard to say. And, again, we think our policy's in a good place. I've just discussed reasons why we might change our policy. And, we'll just have to see how the data lead us.
I'm wondering, a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted, and I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot, really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment. And so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with, and that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from our moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So this isn't, I'm not talking about the U.S. context, this is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I'm strongly committed to that, and so are my colleagues.
Archie.
Archie Hall from The Economist. On that sort of stabilization of the labor market question, how much do you see the weakening we saw over the past 6 months, year, as a kind of data mirage around immigration and the government shutdown and so on that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labor market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, and I could go on and on, there are lots of little places that suggest that the labor market has softened. But but you're right. Part of payroll jobs softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And one more on growth and the kind of strong growth outlook, your strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions, and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supportive, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time. And consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from, but the economy overall, growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the Board of Governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability. And so, the best thing we can do for people who are feeling that squeeze is to keep inflation under control and, frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build-out as being positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And, of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case, if you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Beyi. Thank you, Chair Powell. Beyi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress. But the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we will be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is, a lot of it is around energy, oil. And so far, we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but you know, it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but you know, there's growth and there's how fast the potential is growing, and at a time of you know, high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is, you need to look at 12 months because quarterly GDP can be very lumpy. You know, GDP was negative in the first quarter last year. So the overall, over the year, the numbers were nothing like that. You know, it was more in the mid-2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is you know, stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is that, you know, our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, you know, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made it's, you know, that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind, Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, you know, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model, and we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here and like maybe happening now with AI, we're all over that. And, everyone studies those periods, and, we're very clear-eyed about the possibility that this higher productivity may persist. And also that it may not. We're not, no one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output. And it changes the way you think about, potentially, inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time.
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything. And so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
The chairman of the Federal Reserve. That did not sound like a skip. It felt like a pause, and maybe a very long pause at the Federal Reserve. The beginning.
All right, guys, we're done. That is the end of Powell's press conference. A rather boring press conference, if you ask me. I was almost falling asleep there. I think I yawned 3 or 4 times. But yeah, that is it. Few important quotes from Powell that we'll get into in just a moment. But first, what did you guys make of it? Let me know in the comment section. I'll be going through some of your comments. But yeah, rather mixed press conference. I've got a few quotes to bring you that I think were pretty interesting. So a lot of declining to comment on certain matters, especially political matters and the next Fed chair and all of that. But Powell essentially said that he's not bothered about gold and what's going on with the metals market. He doesn't see that as essentially a lack of trust. He said that geopolitical risks are not really impacting the markets too much. So that was relatively positive. He said that tariff inflation is to top out roughly the middle of this year. Okay, so I guess that was also relatively positive. Powell said, the economy has once again surprised us with its strength. He said the debt path is unsustainable. So that was an interesting comment he made. The path with the debt is unsustainable. He doesn't believe the Fed will lose its independence. That was another point he said. What else did Powell said? He said no one's base case at the Federal Reserve is to rate hike for the next move. So pretty much mostly ruling out the next move being a hike, but he didn't explicitly say that. He said he can't really rule out anything, but it's nobody's base case that they will hike as the next move. So most likely the next move from the Fed will be a cut, but it's still going to be quite a while. We'll have to wait most likely before we get any form of cut from the Fed. He said tariffs are most likely a one-time price increase. So yeah, those were kind of the main points. He didn't want to comment on what's going on with the dollar. He didn't want to comment with regards to Trump and whether he would stay on at the Fed going forward. So a lot of declining from Powell, but we got a little bit, and I would say mostly it wasn't too negative. Market isn't really seeing a big reaction, but in the whole, I wouldn't say it was too negative. But yeah, let me know what you guys think. We'll get into your comments. Let's see. Yeah, not a great deal mentioned about QE. They should press him harder, how the media presses Trump. That's true. They gave him an easy time. He could easily just decline to comment, and they were fine with it. They were just laughing about it. Yeah, very boring for sure. But yeah, let's take a look at how it's impacting Bitcoin. So if we take a look at Bitcoin here in the short term, you can see that we're in a bit of a triangle here. We've got higher highs, but we're maintaining the same base. Major support at this level here of 88.8K. We had multiple rejections at this level before eventually we got a break above. We then retested this level multiple times, and it's acting as a very key level for Bitcoin. If you're below 88.8, you're looking quite bearish, I would say. If you're above it, then we're looking quite positive. And if you look at Bitcoin on the 5-minute here, steadily rising after the conference has just ended, but not a great deal of volatility during this actual speech. Usually we get a lot more volatility, but I guess a lot of stuff was already expected regarding this this conference. I mean, there was no major announcement, so nothing crazy occurred. So I guess it's going to be up to Bitcoin now where it moves with the FOMC now behind us. Again, a lot of the liquidity is to the upside, so I do favor that move up in the coming weeks, but there could be a little bit of chop in the meantime before then. We do have a government shutdown most likely coming. That is something to be aware of. Well said, Corey. But let's go ahead and check Polymarket now, see how the probabilities have adjusted subsequent to Powell's speech. So obviously January already done now, no rate cut. The probability of a rate cut in March has significantly dropped. You're now looking at a 91% chance that the Fed do not change the interest rate in March. That is March 18th, the next Fed decision. So most likely they're going to pause again in March. And looking forward to April, the chances of no cut again have increased. 75% chance of no cut April 29th. So whatever Powell has said today has led to the market thinking that the proposition of a rate cut in March or April is very unlikely. So they've decreased the odds even more for a rate cut in March and April. They were already very low, the chances of a rate cut, but they've gone even lower now. So it seems highly unlikely the Fed cut rates in the first half of the year. Let's see whether they will cut rates at all this year. Let's see what Polymarket is saying. But yeah, seems like Powell will not cut rates again. It'll be the new Fed chair who will cut rates. So that's it for Powell pretty much. He's going to be on pause for the rest of his tenure now. Let's see. Fed rate cut. Yeah, how many Fed rate cuts will there be in 2026? So what is the most likely here? Most likely is 75 basis points. So maybe they're going to do 3 in the back end of the year, in the second half of the year. So 3 rate cuts, meaning 75 basis points total, has a 25% probability. 50 basis points this year has a 23% probability. 1 rate cut has a 12%. 0 has a 9%. So probably they will cut, but it's going to be later on in the year rather than earlier on in the year. That is the most likely scenario. So it'll be the new Fed chair who will cut. Most likely Powell will not cut during his term or the rest of his term. So basically, we ain't getting any cuts until Trump's new Fed. Yeah, that's my base case. 87K is the average spot buy on the ETFs. It's also major support and resistance, so that probably makes sense as to why that is the case. But yeah, we're looking for Bitcoin to potentially get a move to the upside here. Let's see what it can do. But yeah, not a big mover, that press conference, to be honest. It wasn't a big mover. I wasn't expecting it to be huge, to be honest with you. We already had QT ending a good few months ago now. There was no real announcement, no real surprise, so not a big shock to me. Not a big shock to me at all that the market isn't moving massively off this FOMC, but time's going to tell. I do believe Bitcoin is going to make a move to the range highs here at some point before eventually going lower. I believe this move will be the complacency shoulder, and this will be the last chance to exit most likely before we enter some form of a sustained bear market. I see Bitcoin most likely bottoming out at the 200-week simple moving average. Okay, that's the SMA, not the EMA, but the SMA. And you can find where that will be by basically going onto TradingView, going onto the weekly, and then selecting your length as 200. And what you're going to see is that moving average right now is hovering around $58,000. I do believe that that is going to be creeping up over time, obviously, because Bitcoin has been going up, and we'll probably meet it somewhere in the 60s, most likely. Could be in the 70s, depending on how long it takes to get there. But most likely, we're going to meet that 200-week moving average somewhere in the 60s, and I believe that is a great price to start going shopping on Bitcoin. But until that happens, we're very much in like no man's land here. We're not super expensive like we were up here, but we're also not super cheap like we will be whenever we pull back to the 200. We're very much in a period of no man's land or purgatory, whatever you want to call it, right? But Bitcoin maintaining this range despite the fact we had a little bit of a scare on Sunday We managed to survive. I called this move. I said we would probably bounce from support. I gave some solid trade opportunities to you guys as well. Hyperliquid being one of them, which is the biggest gainer in the entire market. So highly recommend you guys join the VIP group. There is a link down below to the VIP group. If you use the code tariff at checkout, I believe you'll save 40% off. I think that discount code expires this week, so make sure to use it. If you are interested in joining any of my membership options, it applies to all of them. The big bundle is a lifetime mentorship package, which gives you course access, one-to-one coaching, and much more. And the VIP gives you my buy alerts, my sell alerts, and access to the Discord group, which is active 24/7. I go in there doing voice chats pretty much every day of the week. I'm in there doing voice chats, talking to the members. I do live streams as well for them as well, answering their questions. So definitely join the group. There's a link down below. Yeah, people are doing quite well in there. So definitely make sure to join. So yeah, not a big one, this one for Bitcoin. This FOMC was fairly tamed, but I still believe we're going to be seeing that move up over time. Most likely, we're going to see Bitcoin head towards 100K in the coming weeks before essentially rolling over to the 200-week moving average. Guys, I appreciate all of you watching the live stream today. Check out Blowfin as well. There's a link down below to the exchange, which I personally use, and there is a current giveaway available where you can win some USDT awards or rewards, either or. It's past midnight here, guys, so I got to get some rest, but I appreciate you watching, and yeah,